The final layer of the financial fortress must be built against a threat that is invisible, digital, and absolute. The central bank digital currency, CBDC. Stop and imagine this scene for a moment. You wake up and look at your bank balance. The money is still there. It hasn't been stolen. But when you try to buy groceries, the purchase of beef or high-protein food is blocked because the code says you can only spend your food allowance on government-approved vegetables. When you try to book a trip, the transfer is frozen because your digital carbon score is flagged as too high. You have the money, but you lack the permission. This is not science fiction. This is the future they are selling you as digital efficiency. This is the CBDC. Your new account manager is the government. This is the ultimate evolution of Executive Order 6102. They don't need to physically confiscate your wealth anymore. They simply program your obedience. We have spent our time detailing the historical blueprint for confiscation, Executive Order 6102, and how a collapsing sovereign will use the systemic failure of the petrodollar to seize the most liquid assets, paper gold. We then established the defense strategy, Pillar 1, legal reclassification, numismatics, and Pillar 2, jurisdictional distance, the three havens. But all of these meticulously crafted defenses, whether physical, numismatic gold safely secured in a Swiss vault or legally classified coins moved beyond the reach of capital controls, are rendered utterly moot if the government can simply control your ability to transact in the first place. The CBDC is the mechanism that achieves this total control, making the need for a physical EO 6102 unnecessary. Why dispatch agents or issue complex legal orders to seize your assets when the government can simply issue a command to the central ledger and switch them off or reprogram their spending permissions? This is not a theoretical debate about making payments faster or optimizing the banking rails. This is the final irreversible weapon of the insolvent state. The CBDC is not about making transactions more efficient. It is about making you controllable. It is the ultimate fusion of state power and digital surveillance, designed to eliminate the one crucial element of freedom that remains in the financial system: the freedom to transact privately and autonomously. The CBDC effectively makes the government your sole banker, regulator, and ultimate judge of how, when, and where you are allowed to spend your own money. The state transforms the currency into a weapon of compliance. If you fail to prepare for this final digital takeover, all your historical knowledge and offshore preparation will be useless, because your entire economic life will be reduced to a programmable entry on a single central ledger controlled by the sovereign. Section 1. The historical precedent for programmed money. The CBDC is often presented as a futuristic concept, but the underlying principle, money that is not a true store of value, but a tool of state policy, is deeply rooted in history. It is the technological fulfillment of the totalitarian impulse. Consider the Soviet ruble during the Cold War. It was not convertible. It was strictly controlled by the state bank, Gosbank, and was divided into categories: rubles for consumers, rubles for government agencies, and rubles for international trade. Money held by the state was hard money. Money held by the citizen was inherently soft and could not be used to acquire real capital or flee the jurisdiction. The value was defined by the state's permission to use it. The CBDC achieves this same level of segregation and control, but with cryptographic certainty. It is the digital Soviet ruble. Instead of physical restriction, not allowing certain rubles to cross borders, the CBDC uses code to enforce policy. This is the final step in the historical pattern of fiat currency collapse. When the money loses its economic function, store of value, the state forces it to serve a political function, tool of control. This is the inevitable path of empires drowning in unserviceable debt. Section 2. The illusion of innovation and the absolute reality of control. To understand the severity of the CBDC threat, we must strip away the marketing jargon. Central banks are presenting the CBDC as a modernization effort, a more efficient, safer, and faster replacement for commercial bank money and physical cash. This is the illusion of innovation, a classic government sleight of hand. The reality of control resides in 5 key characteristics that fundamentally differentiate a CBDC from the current forms of money. 1. direct liability and the elimination of commercial banks, the firewall collapse. Today, your money is a liability of a commercial bank. If the government wants to seize or freeze your deposit, it must first issue a sweeping order that compels thousands of legally separate commercial banks to comply. A slow, legally complex, and politically risky process. A CBDC, however, is a direct liability of the central bank. Your digital currency would be a direct obligation of the sovereign. This eliminates the commercial banking firewall entirely. The government does not need to send an order to 5,000 banks. It only needs to flip the switch on the one central ledger it controls. Confiscation and freezing are instantaneous, automated, and executed at the highest administrative level. You are now directly under the control of the sovereign. No intermediary, no legal delay. This is the core infrastructural change that facilitates a digital EO 6112. 2. Programmability and expiration, the compliance mandate. This is the most dangerous politically charged feature of the CBDC, programmability. Unlike physical cash, which is dumb and fungible, a CBDC is merely a line of code. That code can carry intricate conditions and restrictions imposed by the government, turning your money into a tool of behavioral enforcement. Expiration dates, the war on savings. The money could be programmed with an expiration date, forcing you to spend it within a certain time frame to artificially inflate consumption and stimulate economic activity, a direct elimination of your right to save and hoard capital. This is the ultimate fight against deflationary pressures caused by a collapsing petrodollar. Restrictions on use, the political purge. Money could be strictly restricted to specific purposes. Your wealth becomes a rental currency. You are allowed to use it under conditions, but you never fully own it. It could be programmed to prevent spending on organizations deemed politically undesirable, independent media, political donations to opposition parties, or certain asset classes, like independent physical gold dealers or non-custodial crypto exchanges. Negative interest rates, the tax on thrift. The CBDC facilitates the instant and automatic application of severe negative interest rates directly to your savings, effectively taxing you for holding onto your money instead of spending it into the government's desired economy. A direct and unavoidable assault on the concept of capital preservation. The programmable nature of the CBDC transforms your wealth from a tool of individual freedom into a tool of state compliance. Your economic decisions are now dictated and limited by the sovereign's political, economic, and even social goals. 3. Transaction-level surveillance, the omniscient state. The CBDC is an omniscient surveillance tool. Every single transaction you make is permanently recorded directly on the central ledger, linked inextricably to your verified digital identity, KYC-AML. The elimination of privacy. The CBDC is designed to eliminate cash entirely, removing the ability to make any transaction that is not recorded, analyzed, and stored by the state. Instant algorithmic penalties, financial flash freeze. The system is not just tracking what you buy, it is tracking who you support. A payment to a politically dissenting group? A large transfer to an offshore vault in Singapore? The algorithm can freeze you in milliseconds without a warrant and without appeal. This is financial surveillance at flash speed, transforming the government into an algorithmic financial judge, jury, and executioner. If the sheer scale of this centralized digital control has raised the alarm in your mind, you are recognizing the most profound threat to financial autonomy in history. Hit the like button now to ensure this warning about the CBDC's true purpose reaches those still debating the virtues of digital convenience. And stay with me as we reveal the only technological firewall. Pillar 3, Self-Custody. Section 3, the Pretext and the Minsky Moment. The government will not introduce the CBDC by focusing on control. They will use two unavoidable, overlapping crises to justify its swift, urgent implementation, positioning it as the ultimate solution to the systemic risks exacerbated by the fall of the petrodollar. Pretext 1. The Minsky Moment and Liquidity Crisis. The collapse of the petrodollar will inevitably lead to a liquidity crisis in the US Treasury market and a massive deleveraging in the global banking system, a textbook Minsky moment. bank failures will become systemic. The government will present the CBDC as the risk-free alternative to commercial bank deposits. They will claim that CBDC, as a direct liability of the Fed, is safer than commercial bank money, thereby preventing future bank runs. However, this supposed safety comes at the cost of freedom. The moment you transfer your commercial bank deposits into a CBDC, you voluntarily move your funds from a system with a firewall, commercial banks, into a system of direct, centralized control. It is the ultimate bait and switch, trading the risk of bank failure for the certainty of state control. The only risk remaining is the state itself. Pretext 2. The control of capital and the hyperinflation gap. The crisis accompanying the end of the petrodollar will force the government to look for trillions in new non-debt-based funding to manage hyperinflation. They will justify the CBDC as the indispensable tool to eliminate the massive tax gap created by the underground economy and illicit financing. By eliminating cash and centralizing all transactions onto the CBDC ledger, every single transaction, large or small, is instantly taxable and traceable. This immediate massive increase in the state's tax base provides the funding needed to temporarily service the skyrocketing national debt and fight the hyperinflation caused by the collapse of the dollar's reserve status. The CBDC becomes the most efficient algorithmic tax and compliance collection tool ever invented. This is the government choosing financial survival over citizen autonomy. The CBDC is not merely money, it is a financial operating system that runs your economic life. And just like any operating system, the developers, the government, retain the ultimate administrative privileges to modify, patch, or shut down its users. Section 4. The Technological Firewall, Pillar 3. The CBDC's power is absolute, only over centralized, state-issued money. The defense, therefore, lies in divorcing your economic activity entirely from the state's digital ledger. This is Pillar 3 of the Protocol 6102 defense, technological self-custody and decentralization. This pillar focuses on securing the wealth that cannot be physically moved offshore, specifically digital, and hard-to-move assets, by exploiting the design flaw in the CBDC, its dependence on centralization. Defense 1. The principle of self-custody, the cryptographic lock. This is the single most important technological defense. If you don't hold the private keys, you don't own the asset. The CBDC threat. The CBDC is a custodial asset. The central bank holds the private keys and the administrative access. The digital solution. Digital assets, like truly decentralized cryptocurrencies, not paper-backed crypto ETFs, must be held in non-custodial wallets where only you possess the private keys, seed phrase. The power of this solution is rooted in advanced mathematics, cryptography. When you hold the private keys, the asset is not an entry on a central corporate or government ledger. It exists on a decentralized network. No court order, no CBDC switch, and no centralized authority can freeze, move, or seize those assets without the key holder's input. This is the ultimate technological barrier to seizure, impervious to legal and political commands. Defense 2. Decentralized transaction networks and anonymity. The CBDC aims to make cash obsolete, forcing all commerce onto the centralized grid. The defense is to use decentralized communication and transaction layers that function entirely outside of that grid, restoring the anonymity of cash. Peer-to-peer networks, utilizing peer-to-peer, P2P systems and secondary layers, like the Lightning Network for Bitcoin, allows for transactions that do not rely on a central intermediary, a centralized exchange, or a government-controlled banking rail. These are the modern digital equivalent of exchanging physical gold coins without the state's knowledge or permission. Anonymity sets. True financial privacy in the digital age requires utilizing anonymity sets and privacy-preserving tools, e.g., coin control, mixers, or privacy-focused coins, to break the digital trail that FATCA and the CBDC are designed to enforce. This is the digital equivalent of wearing a mask. It prevents the algorithmic judge from linking the transaction back to your verified identity. Defense 3. The multi-signature legal trust, the geographically segmented key. For managing substantial digital wealth, simple self-custody carries the risk of lost keys or death incapacity. The final evolution of technological defense is the multi-signature, multi-sig legal trust, integrating pillars 2 and 3 for robust inheritance and seizure resistance. The structure. A multi-sig wallet requires multiple private keys, e.g. a 3 of 5 scheme, 3 keys needed out of 5 total to authorize a transaction. The integrated defense. The 5 keys can be strategically distributed among geographically diverse and legally segmented entities. Key 1 and 2, held by the individual and a trusted family member. Pillar 3, autonomy. Key 3, held by a legal trust or foundation domiciled in Switzerland. Pillar 2, historical neutrality. Key 4, held by a legal foundation domiciled in Singapore. Pillar 2, modern stability. Key 5, held by an independent legal counsel in Liechtenstein. Pillar 2, legal certainty. This setup ensures that a. No single sovereign, domestic or foreign, can unilaterally seize all the keys. b. The asset cannot be moved without the legal approval of structures in at least 3 politically neutral jurisdictions. And c. The wealth is protected from both technological failure, lost keys, and political coercion, government seizure. This framework transforms the digital asset from a simple ledger entry into a complex legally and geographically segmented fortress that no single sovereign can breach. It is the fusion of the best technological defense with the strongest legal defense. The CBDC is the final stage of financial centralization. It is the government saying, "We own your money and we decide your economic freedom." The answer to that absolute claim must be absolute decentralization and the removal of the asset from their sphere of influence. We have now laid out the complete Protocol 6102 fortress, from the legal classification of assets to the use of foreign jurisdictions, and finally to the technological firewall of self-custody. The clock is ticking on the petrodollar, and the window for implementing this defense is closing fast. The illusion of safety must be replaced with the reality of sovereignty over your own wealth. If this deep dive into the CBDC threat and the technological firewall has finalized your understanding of the financial landscape, you are ready for the final step. Click subscribe now to master the principles that survive every empire's collapse. Do not wait for the government to become your banker. Master the rules of autonomy today.